Hi everyone, thanks for tuning in today for another edition of our case study series. My name is John Kornacki and I'm the financial strategist here at the Federal Home Loan Bank of Boston. The title of our case study today is Revisiting the Last Fed Taper and Rate Hike Periods. So there's been a lot of talk over the last several weeks and months about, when is the Fed going to start tapering its asset purchases? What's that going to look like? When is the Fed going to begin raising rates? How does that impact me as a depository institution? So, the Fed has announced now that in November it's going to begin tapering MBS and Treasuries. So this is a good opportunity to go back and look at what happened during the last time when the Fed tapered their asset purchases and raised rates. So I have a timeline here. This is starting at the third round of QE, which was September 2012 to December 2013. Then you see the Fed began to taper and tapered from December 2013 to October 2014. Then it wasn't until a year later where the Fed began to raise rates in December 2015. And it wasn't until 2 years after that that quantitative tightening began. So just to give everybody a refresher, quantitative easing is where the Fed is buying up assets in the market. Tapering is when it's reducing the asset purchases. It's still purchasing a net increase of assets every period, but just not to the same level. Then quantitative tightening is the actual reduction of those assets that are built up on the balance sheet of the Fed. And so you see from October 2014, from when the Fed stopped its taper, to October 2017, when it actually began tightening, there's a 3-year gap in between that. And that's going to be key to our discussion a little bit later on. So keep that in mind. But what we're going to talk about today is how did this impact Treasury rates? What did the yield curve look like? What was the impact to cash balances at depositories? And then another big thing here is deposit betas. Obviously we're in a zero rate environment right now, and folks are able to fund assets at near zero rates. So as rates begin to rise, that's pressure on our depository institutions. So we're going to look and see what happened last time as rates rose and what the lag looked like, and we'll dig into that a little bit. So let's start off by looking at the Treasury yield curve at various tenors. One of the things that folks will assume when they hear the Fed's going to taper is that rates will rise, and the thought is with less purchases by the Fed, there will be less demand, and so with less demand, rates will rise. But as you can see from these three tenors here, that's not necessarily the case, and it's not what happened last time. So starting on the far left here, you see the 3-year Treasury yield. 3-year Treasury yield rose during QE3 and rose during the taper, and so you could deduce that the Fed hikes were starting to be priced in. As the taper continued, the market was expecting a rate hike to come, so those rates rose. Then you go a little bit further out, 5-year and 10-year, and those are not so much impacted by Fed rate hikes. The Fed can control the short end of the curve, but not so much as you go further out. And so as I mentioned, a lot of folks would think as a taper, the rates will rise when there's a taper, and that in fact didn't happen. You look at the 5-year. The 5-year was pretty flat. There's some noise in there, but from beginning to end, the 5-year stayed pretty flat throughout the taper period. And then you look at the 10-year, the 10-year dropped. So that belief that once the Fed starts tapering, rates will automatically rise because there's not a large buyer in the market is not necessarily the case. And the big difference between now and in back in 2013, 2014 is there's also a lot more cash in the system as a whole, and there are buyers. A lot of depository institutions love treasuries. So as the Fed begins to taper, even if rates start to rise, there's the possibility that you have a lot of cash waiting on the sidelines, ready to pounce on that whenever there's just a little bit of an opportunity. So it's something to keep in mind as we look ahead to this next period where taper takes place. Something else I want to revisit here is cash balances. So folks have different beliefs on what happens to cash during quantitative easing and quantitative tightening. So I looked back here and broke cash assets on all commercial banks. I broke it out into different periods, QE3, taper, and quantitative tightening being the components, and then there's a gap, as I mentioned earlier, between the taper and quantitative tightening. So cash grew quite a bit during quantitative easing. If you look at the bottom chart here, you see compound annual growth rate of 49%. So no doubt cash balances grew. There's some expectation that with a taper that would mean potentially cash could flood out. But if you look back in 2013, 2014, 2015, it's not necessarily the case. And so you focus on the green here first, the taper. There were still net cash increases of 13% annually. So not as significant as the 49% you saw during quantitative easing, still pretty large amounts. Then, as I've said, there's a gap. Cash started to go down, minus 7% annually. It's a pretty big number, but when you think about how much built up over that time, it's nothing to really have a significant impact to all the cash that was there. But then you start to get to the tightening, and that's where you actually see cash balances decrease. And so that far blue area is where you see almost 20% annual decline in cash. And so it's something to keep in mind here, because when you look at the last time this happened, the taper ended, and it wasn't until 3 years later that tightening took place, and that's where you saw significant decreases in cash. So we don't know for this time, what that lag will be between taper and tightening, but it's not likely that the tightening will happen right after the taper. So keep that in mind when you think about managing your balance sheet and the impacts this could have to both assets and liabilities. Shifting gears here a little bit, we're now going to talk about deposit costs and what happened during the last Fed rate hike cycle. And we're going to measure this in terms of deposit beta. And if you're not familiar with deposit beta, it's basically how responsive is deposit pricing relative to changes in market rates. And market rates for what we're looking at today are Fed funds, and the deposit costs are interest-bearing deposit costs for FHL Bank Boston depository members. So we're starting back in 12/31/2016. One hike had already happened by this time, so we're starting at 75 basis points for Fed funds, as indicated by the blue X. As you go across, you start to see some hikes coming in, but deposit beta is not moving. And I'm focused here on the dark green line bar, which is our median deposit beta. And it's really not until you start to see Fed funds get over 2% where there's actually some significant moves. Still lagging, but that's where you start to see those jumps. And I mean, keep in mind, this is 7, 8 Fed hikes at this point. So this is a significant lag. It's not like, Fed is raising rates and depository members are out there trying to keep up with the Fed. There's a significant lag here, and that's a benefit to depository institutions. As you keep your cost of funds low, you're able to benefit on the asset side with lending and investments, and so that's a way to expand margins. So you see that it's not until 2% where you see these betas hit 23%, 40%, 62%. So keep that in mind as we approach this next Fed cycle. If you're able to keep your betas low while the Fed hikes, also keep in mind, the Fed hiked quite a bit last time where they got to 2.5%. If you look at what the market is pricing in now with expectations, it's not expected to reach those levels. So we might get quick rate hikes, but they might not go up to 2%. So also keep that in mind as you think about deposit costs and being able to lag Fed funds. Now that we've kind of looked back at the last cycle and seen, what happened and impacts to treasuries and cash and betas, let's talk about a strategy here. There's no question that our depository members are facing challenges from a number of different angles, and one of them is earnings compression as loan yields come down with assets repricing. One of the things that we see in here is that members are more asset sensitive than they have been in the past. And part of that is the significant amount of cash that's come in at depository institutions. So one way to take advantage of what's happening in the market is you've seen the yield curve steepen. You've seen some better asset pricing in recent weeks and months, and the ability to fund those shorter is a real opportunity to increase spreads. And so we're looking at 3 different strategies here, all 20-year MBS. So I'm looking at a 170 5-year average life. And the funding side of things is really the difference in each of these strategies. If you're fortunate enough to have the core deposits to fund at, this example, 10 basis points, and depending on what you assume your average life of your deposits are, you can match fund that with 160 basis point spread. And that's plus 34 in the last 3 months alone. And that, as I said, rates have gone up further out on the curve. So if you're asset sensitive and you have the willingness and ability to extend out further, you can extend your assets out further while staying short on the liability side. So especially if you have those core deposits in there. If you don't have enough core deposits or as much or if you don't think the average life on those core deposits is really going to be 5 years, you can fund this with a mix of core deposits as well as some wholesale funding. So the second example here is looking at 50% core deposits at 10 basis points and 50% 1-year classic advance, which gets you to an all-in funding cost of 21 basis points with an average life of 3 years. So spread is 149 basis points. And your average life spread here is 2 years. So you're taking a little bit of interest rate risk, but depending on what your ALM is showing right now, you may be able to extend assets quite a bit and still be super asset sensitive. So something to keep in mind when you're trying to weigh the ALM side of things and look at earnings as well as excess liquidity. where there are opportunities to potentially extend assets and fund those assets with core deposits or wholesale, depending on your risk appetite and excess cash levels. Also, something to keep in mind here as you look at funding longer assets. I did mention earlier that the Fed has greater control over the short end of the curve, and so this chart here is plotting the effective Fed funds along with the 3-year Treasury. If you look back, you see that 3-year Treasury was pricing in Fed hikes before they happened, and so that's important to keep in mind because we talked about deposit betas, right? If your deposits are more rate sensitive, or if you're wholesale dependent, it's important to keep an eye on the Fed playbook here, because as you look at the right side of this chart, you see the 3-year Treasury has creeped up over the last several months, and so the market is essentially looking ahead to those Fed hikes. So when you think about funding assets longer, do you also need to extend liabilities longer in order to purchase those longer bonds? If you are deposit rate sensitive or wholesale dependent, it's something to consider when looking at what's happening with rates and how you're typically your customers react to changes in market rates. So I want to take a look at one more strategy before we finish today. We call this one Restructure and Invest. So if you have excess cash, you want to take advantage of a steepening yield curve, but you're liability sensitive, or you're worried about rising short-term rates, as well as having an advance on the books that you can restructure, then there may be an opportunity here to consider. So I'm going to frame this in a way to show you two different options so you can see the impact. Option one, you take your excess cash, you invest it out to a 20-year MBS at 170 basis points with an average life of 5 years. So you're getting plus 155 for extending out 5 years. So the question that I pose is, do you have the ability and willingness to extend assets 5 years? If your answer is, maybe or no, then the other option to consider is you take the same asset purchase, but you combine that with a advanced restructure, and you get a better net impact. And so on the liability side, you take your advances, you save 51 basis points with the restructure, you extend the average life out a little over 1 year. So the net impact of combining the asset and liability restructure is you get 210 basis points on the net impact, and you're only taking 3.7 years of interest rate risk with the combined strategy. So from option one, you saw plus 155 on 5 years. This is plus 210 on 3.7 years. So you're taking less interest rate risk, getting more pickup, and so you're affording yourself the ability to extend out further on the curve while protecting yourself by extending your liabilities out further as well, if you don't have the willingness or ability to take that additional interest rate risk of buying 20-year MBS with where your current balance sheet is. So that concludes today's presentation. As always, thanks for joining. If you have any follow-up questions, I'm happy to answer them. So you can reach out to myself or your relationship manager. We're always available to talk through any ideas or thoughts that you have. So Thanks again for listening in, and have a great rest of your day.